Okay, let's unpack this one. Firefly Neuroscience, ticker AIFF.
Right. The AI company focused on brain health.
Exactly. They're using EEG data, their BNA platform, Brain Network Analytics. We've seen some chatter about the stock recently, and you asked us to dig in.
Yeah, see what's behind the headlines.
So that's what we're doing today.
And it's interesting, isn't it, trying to use AI to, get more objective insights from brain activity. EEG analysis can be pretty subjective traditionally.
That's the promise, right? A more data-driven approach.
Okay.
Welcome, everyone, to the Deep Dive. This is where we take the sources you provide, like the analysis for today, and pull out the key insights.
Giving you that shortcut to getting up to speed.
Exactly. This is tailored for you, the learner, someone who wants to really grasp complex stuff quickly, efficiently, without getting totally bogged down.
We aim for those surprising facts, the aha moments.
We do. And, hey, if you find this valuable, definitely like and subscribe to Stock Analytics AI on YouTube. Quick plug, Euro $4.99 a month, members can suggest a ticker and get a prioritized deep dive, analysis, earnings, the works.
So today's mission, if you will, is to really understand Firefly. What's their core value? How healthy are they financially? Where do they sit in the market?
And what are the key things that'll decide if they succeed or don't?
Pinpoint those critical factors.
Absolutely. Our main source today is a detailed research analysis dated May 21st, 2025. It looks at Firefly through a value investing lens.
Which is an interesting angle for such an early-stage tech company. Forces you to look hard at the fundamentals.
It does. It covers the business model, management, financials, market sentiment, risks, the whole 9 yards.
So we need to get a handle on what they actually do, how their finances look, who's in charge.
Before we can really talk about market view or risks, makes sense.
Laying the groundwork.
All right, so first half, business understanding, management evaluation, and financial health. Let's dive into Chapter 1, business understanding.
Okay.
So Firefly Neuroscience. Core focus is AI for neurological and mental disorders. Their flagship product is this BNA platform.
And importantly, it's FDA cleared. That's not trivial.
Not at all. Software is a medical solution using AI, machine learning, on EEG data.
The goal being to help diagnose and monitor conditions. What, like depression, dementia?
Yeah, depression, dementia, anxiety, concussions, even ADHD.
It's applying AI to that complex EEG data. Traditionally, reading those brainwaves is really skilled work, very expert-driven.
Right, those squiggly lines.
Yeah. So AI offers a way to make it more quantitative, standardized, maybe. It's looking for subtle patterns the human eye might miss.
Okay, so how do they make money from this, or plan to?
Well, the model is basically providing the BNA platform to healthcare providers and pharma companies, too.
So selling licenses, maybe usage fees.
Potentially, yes. Sales, licensing, usage fees tied to the EEG systems, maybe data analysis services down the line.
But the key thing is revenue is tiny right now.
Very tiny. The analysis mentions $43,000 in Q1 2025, primarily North America.
Wow. Okay, that really highlights how early stage they are. FDA clearance is one thing. Getting doctors to actually use it and pay for it, that's another.
Exactly. The commercialization journey is just beginning.
Let's look closer at the BNA platform itself.
Yeah.
FDA 510K clearance, we mentioned that, and the CE mark for Europe.
Those are big regulatory hurdles cleared. They signal safety and that it works as intended.
And how does it work? It analyzes EEG data during rest and also cognitive tasks.
Right. Then it compares that specific patient's data against a large database of normal brain activity.
To spot deviations.
Precisely. To see how an individual's brain patterns differ from that baseline, that comparison is key.
Giving clinicians insights for diagnosis or tracking treatment response.
That's the idea, providing actionable insights into brain function, especially cognitive function.
And the range of conditions is broad depression, anxiety, Alzheimer's, Parkinson's, concussion, ADHD.
It is broad, which shows the potential versatility, but also means they need to prove its value in each specific area against existing methods.
Now, this database you mentioned, this sounds crucial.
Oh, it is. It's a huge proprietary asset. Standardized EEG recordings. Includes ERP's event-related potentials.
Brain responses to specific triggers.
Exactly. And longitudinal data tracking the same people over time. It was already sizable, over 17,000 records.
But then they acquired Evoke Neuroscience.
Right. And that acquisition massively boosted the database. Now over 180,000 records.
180,000. That's a lot of data for training AI.
A huge amount. And that longitudinal aspect, tracking changes over time, is particularly valuable, hard for competitors to replicate quickly.
So that database database is a potential moat, a barrier to entry.
Definitely. In AI, data is king, quality and quantity. This gives them a real edge.
Okay, market position.
Yeah.
They're in the tech sector, software, focusing on AI and neuroscience.
Their value proposition is all about improving brain health outcomes, better assessments, more personalized treatments.
Trying to redefine the standard of care for cognitive issues. Ambitious.
Very. And they're hoping the Evoke deal helps solidify that position. Whether they can deliver tangible improvements in cost effectiveness, that's the challenge.
Let's zoom out to the industry. Neurodiagnostics is a big market, right? And growing.
Absolutely. Multi-billion-dollar market globally with solid growth projections driven by tech advancements, sadly, the rising prevalence of neurological disorders, and just more awareness.
And the AI piece within that is growing even faster.
Corrected to, yes. Very strong CAGR forecasts. AI is seen as a way to boost diagnosis, treatment, drug discovery.
So it's not just about better diagnostics, but maybe finding new uses for old drugs or new biomarkers.
Exactly. AI's impact is potentially huge, from basic research right through to patient care.
Okay, competition. Who are they up against?
It's a crowded space. Direct competitors with similar EEG analysis platforms. You've got Cerebell, they do rapid EEG for seizures. Cumulus Neuroscience, doing at-home EEG for trials. Beacon Biosignals, focused on EEG biomarkers. Then others like Inseria, BioSerenity, BrainScope, Mind Analytics. It's a varied field.
So some are very niche, others broader.
Right. Firefly needs to carve out its space and show clear advantages, especially for those cognitive disorders they target.
And beyond direct EEG competitors.
There's a wider group using AI in neurology, active surgical, brainomics, big players like Medtronic, even IBM looking at drug repurposing.
So established giants and nimble startups.
It's a mix. They need strong tech and a killer go-to-market strategy.
And regulation is obviously huge here. FDA, CE mark, we know they have those.
Critical, but it's ongoing. Compliance with quality, safety, data privacy like IT Pay Arc, it's intense.
Plus potential trade issues, tariffs impacting devices.
It adds complexity and cost. But getting those clearances, like the 510K, is also a competitive advantage, a stamp of approval.
And barriers to entry are high overall.
Definitely. R&D costs are steep, development cycles can be long, regulatory hurdles are significant.
Need proprietary data, IP, clinical validation.
And then you have to actually convince doctors and hospitals to adopt it. Build trust.
That database really helps with the data barrier, though.
It does. It's one less hurdle and a significant one.
Okay, let's talk competitive advantages. Their potential moat. Brand.
Still developing, I'd say. The FDA clearance helps build it. Strategic moves like Evoke, partnering with NVIDIA, those are brand building steps.
Scale. They're small. Right?
Very small. Low employee count, market cap. The Evoke deal did increase their commercial user base, though.
Network effects. Does the platform get better as more people use it?
Potentially, yes. More data could refine the algorithms, but again, very early days to see that kick in.
Switching costs.
Yeah.
Would it be hard for a clinic to switch away?
Moderate potential, perhaps. Integrating a new system takes effort, training, but probably not prohibitive if a clearly better solution emerged.
So the real potential moat comes down to their unique assets.
I think so. Primarily that proprietary EGRP database, the size, the longitudinal data, very hard to replicate.
And their patents. The analysis mentions 27 granted post-Evoke.
Yes, the patent portfolio is another key asset. How broad and defensible those patents are will determine the strength of that IP moat.
And the FDA clearance and CE mark themselves?
Absolutely. They are significant validations and barriers for others. So database, patents, regulatory clearances, that's the core of their potential moat.
And the Evoke acquisition seems squarely aimed at bolstering those assets.
Exactly. Expanding the database, getting more patents, more users, all feeding into that ambitious goal they mentioned, creating a foundation model of the human brain.
Wow. Okay. Let's shift gears to Chapter 2, Management Evaluation. Looks like some big changes recently.
Yeah, significant leadership shifts in early 2025 often signals a strategic pivot or renewed focus.
Who is in charge now? Greg Lipschitz became CEO in March 2025. Background in capital markets, M&A.
Interesting background. And David DiCaprio is president and COO, joined April 2025, experience commercializing AI in healthcare.
That sounds relevant. Then the CFO, Paul Kraswicki, and CTO, Gil Issachar, came in post-merger finance ops and software AI neuroscience, respectively.
Rounded out by Jason Dubrasky as VP of Sales Medical Device Sales background, and an experienced independent chairman, Arun Swarup Menawat.
So the team seems to cover the key bases on paper: strategy, tech, sales, finance.
It looks like a solid lineup in terms of experience profiles. The CEO's M&A background might be relevant too.
How are they compensated? CEO gets $300K base, bonus potential, plus RSUs for 3% of shares.
And the president COO 250 telecase bonus plus RSUs for 2%. Equity heavy.
Which usually aligns their interests with shareholders, right? If the stock does well, they do well.
Generally, yes. Ties their success to the company's long-term performance.
But the analysis points out it's a new team, short tenure together. Big challenge ahead to deliver growth and profits in this market.
True. The experience is there, but they need to execute specifically at Firefly. Track record is still being built.
They list values like integrity, accountability, seems standard. Transparency-wise, they issue corrections, include forward-looking statement warnings, file with the SEC.
All positive signs. Standard practice for public companies, but good to see.
Okay, capital allocation. Where are they putting their money? R&D is obviously key.
Crucial for the B&A platform. R&D spend was up slightly in Q1 2025. They're investing in things like that new cognitive brain age biomarker they announced.
Staying ahead technologically is vital.
Absolutely. And new biomarkers increase the platform's value.
And the big one, the Evoke acquisition. $6 million total, 3MS cash, 3MS stock.
Plus a potential $500 case stock earnout if Evoke hits 3 members' annualized revenue in 3 years.
Strategically, it seems huge. Expanded database, more patents, bigger user base, potential revenue stream from Evoke's history, aiming for that foundation model.
Big strategic bet. But financially, that $3 million cash hit the reserves immediately. And issuing stock means dilution for existing shareholders.
Right, a trade-off. The 3 million member revenue target for Evoke will be a key metric to watch.
Definitely a benchmark for integration success.
Dividends, none, as expected for their stage. Share buybacks, no mention.
Typical. They need capital for growth, not returning it yet.
Return metrics, ROIC, ROE, ROA, all deeply negative.
Again, expected. They're in heavy investment mode, pre-profitability.
So their capital allocation is clearly focused on intangible assets. Data, IP, tech.
That's where the value proposition lies right now.
And that $8.8 million they raised from warrants being exercised was critical.
Absolutely vital. It funded operations and covered that $3 Evoke cash payment.
Let's look at the numbers. Cash was $9.05 at end of Q1 2025 before the Evoke payment. Operating cash burn was $2.05 in Q1.
So post-Evoke cash is closer to $6.05. Compare that to the $2.05 quarterly burn. The runway isn't huge.
Yeah, they need revenue or more cash, fast. Careful cash management is crucial.
Very critical.
Okay, that leads us nicely into Chapter 3, financial health. Let's get into the weeds.
The numbers tell a story.
Right. Key metrics from the analysis as of May 21st, 2025. Share price $3.48. Market cap around $40.6 million.
Okay, nano-cap territory.
Q1 2025 revenue was at $43,000. Now here's that discrepancy the analysis noted.
The trailing 12-month revenue and PS ratio.
Exactly. Depending if you annualize Q1 or use a data aggregator like FinViz, you get very different TTM revenue and PS figures.
Always go to the primary source of the company's filings.
Definitely. Based on annualized Q1, the PS ratio is extremely high.
Yeah.
Suggests the market is baking in a lot of future growth.
Massive expectations. PB ratio around 7.84. Operating loss, net loss, both substantial in Q1. Loss per share also widened significantly.
Balance sheet snapshot, March 31st, 9.545 meter cash, current ratio 1.45, no formal long-term debt listed.
The high PS screams market optimism. The losses in cash positions scream early-stage risk.
Let's break down the Q1 income statement. Revenue up slightly year over year, but from a tiny base. Gross profit margin, 100% TTM typical for software licensing.
That high gross margin is good scalable if they get volume, but operating expenses jumped.
Yeah, driven mainly by a big rise in G&A general and administrative costs. Could be public company costs, maybe Evoke integration expenses.
Possibly. Something to watch. R&D up slightly, sales marketing down slightly, net result. Operating loss got bigger.
Now, this other income expense line, a huge negative number, negative $10.865 million in Q1.
Right. Mostly from changes in derivative fair value and a loss on settling a convertible note. These aren't core operations.
Explain those, non-operating items.
Exactly. Related to financing activities. Derivatives are financial contracts. Their value changes with the market. Convertible notes are debt that can turn into stock. Settling them can incur costs.
So they don't reflect day-to-day business performance, but they have real financial impact. Dilution, maybe cash needed later.
Precisely. They hit the bottom line hard. Net loss for Q1 was $12.09. Net loss to common stockholders even higher due to a deemed dividend on warrants.
Leading to that big jump in loss per share. Okay, balance sheet again. Total assets, $12.04, mostly cash. Non-current assets, fairly small intangibles, equipment.
Liabilities were $7.02, all current. Accounts payable, accrued stuff that deemed dividend liability. No long-term debt is a plus.
Working capital, current ratio, quick ratio, suggests some short-term liquidity.
Yeah.
But it all comes back to that cash pile being eaten by operations.
It's a classic early-stage growth company balance sheet. Liquid assets, minimal long-term debt, but reliant on cash reserves.
Cash flow statement for Q1 confirms it. Use $2.05 in operating activities, the operational losses. Minimal investing cash used.
But a big inflow from financing activity.
Yeah, that's where the cash came from. Warrant exercises, private placement. Net result was an increase in cash for the quarter, ending at $9.05.
But free cash flow, still negative, still burning cash overall.
So, financial stability assessment. Consistent history of net losses. Earnings, revenue trends declining recently, but they're pre-profitability, no dividends.
The critical point is debt management and liquidity. That pro forma cash of $6.05 post-evoke versus the $2.05 in Q1 burn rate.
Less than 3/4 of runway, unless revenue ramps up significantly or they raise more money.
That's the stark reality. Interest coverage is deeply negative, heavily reliant on equity financing.
Quality of earnings currently, very poor. Future stability hinges entirely on successful commercialization, Evoke integration, generating scalable, high-margin revenue.
It's all about execution now. Can they turn the tech promise into real dollars before the cash runs out?
Okay, that sets us up for the second half. We'll look at market sentiment, ownership, risks, and wrap it all up. Quick reminder, folks, subscribe to the Stock Analytics AI YouTube channel.
Yep, crucial context coming up, how the market sees them, who owns them, and what could go wrong.
All right, Chapter 4. Market sentiment. How's the market feeling about Firefly? Seems kind of mixed.
Yeah, the analysis suggests that. No major Wall Street coverage, so opinions are driven more by technicals and online platform ratings.
Right. StockInvest.us apparently upgraded to buy candidate on technicals, but also noted a falling short-term trend and predicted a price drop. That seems contradictory.
Technical indicators can be complex and sometimes conflicting. Short-term signals versus longer-term forecasts.
TradingView showed neutral for 1 day, but sell for 1 week and 1 month. And Wall Street's in. They were harsh.
What do they say?
Strong sell. And their DCF model put fair value at just 17 cents. 17 cents. Suggests massive overvaluation in their view.
Wow, 17 cents versus the $3.48 price mentioned earlier. That's a huge disconnect. Highlights the speculative nature when fundamental models diverge so much from the market price.
And the lack of traditional analyst coverage is common for these nano caps, right?
Very common. Less institutional focus means more volatility, often driven by retail sentiment and news flow.
Speaking of news, recent events definitely moved the stock. The Evoke acquisition. Company framed it positively, but some analysts worried about the cash burn and dilution.
Understandable concerns. Strategic potential versus immediate financial impact.
Joining NVIDIA's Connect program seemed to give the stock a boost.
Partnerships with big names often do, seen as validation.
Warrant exercises brought in cash, but again, potential dilution concerns likely played a role in the market reaction.
Always that trade-off with equity financing.
And that cognitive brain age biomarker announcement back in January reportedly doubled the stock price.
Shows how sensitive the market is to potential breakthroughs in their core tech. Big reactions to perceived progress.
What about short interest? Is it heavily shorted?
The analysis says moderate levels. Nothing pointing towards a high risk of a short squeeze.
And options activity?
Limited or non-existent, apparently. Typical for stocks this small. Lower institutional interest, less hedging or speculative options trading.
Okay, let's put on the value investor hat. Intrinsic value. The analysis says it's extremely hard to determine here.
Makes sense. Consistent losses, balance sheet heavy on intangibles. Traditional metrics don't really work.
The value is tied up in the B&A tech, the database, the patents, all dependent on future growth, which is uncertain.
Exactly. DCF models, like that Wall Street's in one, become highly sensitive to assumptions. Garbage in, garbage out, potentially.
Liquidation value would likely be very low, much less than the market cap.
Probably. Intangibles are hard to liquidate for full value. Strategic value to an acquirer is also pure speculation at this point.
So the core issue for a value investor is the current price reflects optimism, not backed by current financials. No margin of safety.
That seems to be the conclusion. The technical buy signals clash hard with fundamental overvaluation flags like the Wall Street's and DCF, a classic growth versus value dilemma.
Okay, let's move to Chapter 5. ownership structure. Who owns AIFF? Institutional ownership seems relatively low.
Typical for nanocaps, yeah. Though the reported figures can vary between sources sometimes.
Key holders mentioned. Windsor Private Capital LP seems significant, a major shareholder based on filings.
And Arena Investors LP, also a notable holder, and involved in some financing deals with Firefly.
Vanguard and Geode mentioned too. The analysis suggests these institutions might be more active VCs or special situation funds rather than passive index funds.
Plausible. Suggests investors seeing high potential, but also likely aware of the high risks. Monitoring their SEC filings, 13D, 13G, is key.
What about insiders? Ownership seems high, like 40, 55%.
Yeah, significant insider ownership can be good aligns interests, but also gives insiders a lot of control.
Recent insider transactions, mainly those RSU grants to the new CEO and President COO we discussed.
Right, 3% and 2% respectively. Vesting over time, likely performance conditions, further aligns them with success. No mention of insider sales in the analysis.
So ownership is quite concentrated overall. High insider stakes, key institutions.
It seems so. Potential for faster decisions, maybe more alignment, but less influence for smaller minority shareholders.
The new leadership operates within that structure. Okay, Chapter 6, Risk Assessment. Let's use the SWOT framework from the analysis. Strengths.
FDA-cleared BNA, that huge database, growing patent portfolio, new experienced leadership, large growing market.
Weaknesses.
History of losses, tiny revenue, cash burn, dependence on commercialization success.
Opportunities.
Leverage, evoke, expand BNA applications, capitalize on AI and healthcare growth, potential partnerships.
Threats.
Intense competition, need for more funding, dilution risk, market adoption challenges, regulatory hurdles, tech obsolescence, economic factors, cybersecurity. It's a classic high-risk, high-potential setup.
Let's dig deeper into key risks. The analysis flags going concern, risks.
It notes the factors. Losses, negative cash flow, limited post-evoke cash. Doesn't give a formal opinion, but highlights it as a material risk. Dependence on revenue or more financing is clear.
Execution risk, too. Can the new team deliver on this complex strategy?
Big question mark. Tech development, commercialization, integrating evoke. It's a lot to juggle.
Market acceptance risk. Will doctors actually use it widely? Reliance on key personnel in a small tech firm. IP risks, infringement claims, protecting their tech.
All standard but critical risks for a company like this.
Stock price volatility, already seen that.
Yeah.
High beta. Cybersecurity, managing that huge sensitive database is a massive responsibility. A breach could be devastating.
Their 10K likely details these risks extensively. Tip Ranks also apparently highlights key risk categories.
And funding constraints. Being financially weaker limits R&D and sales and marketing versus bigger rivals. A tough cycle to break.
They need commercial traction and fast to fuel further investment and growth.
Lastly, the analysis looked at the impact of those U.S. tariffs from 2025. Direct impact on their software. Probably minimal.
Right. Software isn't usually tariffed directly, but indirect impacts.
Could be. If the EEG hardware they rely on gets more expensive due to tariffs, it could slow adoption.
Makes sense. Hardware dependency.
Their own R&D costs could rise if they use imported equipment. Customers might have less budget due to broader economic pressure.
And semiconductor tariffs could ripple through the whole medtech ecosystem, affecting prices and maybe U.S. AI competitiveness.
So while the software itself isn't hit, the interconnected supply chain could create headwinds.
A good reminder that few companies operate in a vacuum. Global economics matter.
Okay, we've covered a lot. Chapter 7, conclusion and that hook reveal. Let's bring it all together. A value investor's verdict.
The analysis acknowledges the positives. Innovative tech, big market, valuable intangibles like the database. Evoke and new leadership are seen as potentially good steps.
But it falls short on key value investing principles.
That's the argument. Business may be too complex to easily understand, moat still unproven, management capable but new in role, and crucially, price seems too high, no margin of safety.
Especially compared to that $17 All Street's in valuation.
Right, so the conclusion is highly speculative, more like a venture capital play than a traditional value investment.
Significant financial risks, cash burn, early revenue losses, high valuation based on future hopes. Conservative value investors would likely pass for now.
It fits the profile of high risk, potential high reward, but not the typical value profile seeking downside protection.
What could change that? What are the de-risking factors to watch?
Consistent revenue growth, obviously. A clear path to profit and positive free cash flow. More clinical validation and adoption, successful Evoke integration, demonstrating a real competitive edge, and continued prudent capital allocation.
Those are the milestones. Okay, final thought for you, the listener, to mull over. With AI becoming so powerful in healthcare, especially for understanding the brain, what are the ethical considerations we all need to think about? Companies like Firefly, society, how do we handle this proactively?
It's a massive question beyond just the financials. Privacy, bias in algorithms, equitable access.
Definitely food for thought. Now, remember that hook about Firefly's stock activity?
Yeah.
After this deep dive, you should have a much better sense of the underlying story, the potential, the risks, the recent moves driving that buzz.
Much more nuanced picture.
We've got more deep dives coming up based on listener suggestions, so stick around. Please subscribe if you haven't already. You don't want to miss out.
And definitely subscribe to the Stock Analytics AI YouTube channel.
Yes. Now, the important bit, this deep dive is not investment advice. It's for informational purposes only. Seriously, investing in companies like AIFF is highly speculative. Do your own thorough research. Consult a qualified financial advisor. Okay.
Absolutely essential.
Information here is, as of May 21st, 2025, accuracy isn't guaranteed. We, the hosts, may or may not own shares. And remember all those forward-looking statements we talked about. Actual results could be very different.
Understand the risks, do your homework. That's the key takeaway for any investment.